Good morning, ladies and gentlemen. Well, let's talk about the employment numbers last week because we had a slew of them and what they show. I have included a link on the last slide of today's video where Guy Berger, who I think is probably the best guy to give you an analysis of employment, actually summarizes it very well. I think there are two things going on. One is a very gradual lessening of employment, i.e., a deterioration in the employment figures, which is being caused by substitution. What do I mean by that? I mean that a lot of immigrant labor is leaving the labor force, whether they're leaving the country altogether or they're just in hiding, as it were, and they're being substituted to an extent by unemployed Americans. And naturally, when the unemployed Americans come off the unemployment register, that actually is reflected in the figures. And therefore you are getting this substitution which is masking the real weakness that you are seeing in the employment picture, because everything else is showing it. You are getting a higher unemployment rate, and as you will read from that link, it's very likely that the unemployment rate in the next 3 to 6 months actually exceeds the Fed's and hits about 4.5, 4.6%, because I think that trend is now almost set in stone. So the window of weakness is very much there. It's just that probably it's going to last a little bit longer. Let's talk about what happened on Friday in the bond market. You got an NFP which was not strong by any stretch of the imagination. It just not as weak as the whisper number, which was around the 110, 115 area. And they took the opportunity ahead of the auctions next week to hit the market some. Not surprising, but they're getting to levels where CPI now is really going to be important, and much more important than usual. It's the last piece of data that the Fed is going to get before the FOMC, and therefore it's the one that will decide their dot plots. There is an argument to be made that if CPI is actually high, they will move the dot plots to just one cut. I think that is not that likely. I think they will maintain the dot plots at 2 cuts for 2025, but that is one of the dangers. The other danger, which I think is probably greater, is that it's actually very weak, because I just can't see a situation in which you're having a lot of people leaving the workforce and also a little bit of substitution, and that the consumption is that strong. So I think the odds are greater that CPI is actually weaker than expected, and you get a complete whipsaw in the bond market, even though you have 3s, 10s and 30s auctions next week. Everything has basically gone to support. The 2s have gone to the, this 404 support. Now, what will happen if the CPI is actually stronger than expected? Well, as I said, there is a danger that we go to somewhere like 416, that kind of level, but I don't think there's a danger that we go much higher than that. There will always be a bid for 2s, whether it's the flight to safety or the people who think that they're going to have to cut towards the end of the year. I think if you can get 2s around the 416, 417 area, you're going to do very well with them. 5s, can they get to 427 on a bad CPI? Absolutely they can, but I don't think they're going to go much further than that. The interesting side is 10s and 30s. I've left some room to get long here before Wednesday, 458. And I think that then we could easily test the 440 area where we were before Friday without any problems. The yield curve really didn't do much last week. The interesting one to me is 2s, 5s, which are remaining absolutely in a range and could easily start breaking down hard if we get a weak CPI. The curve has been all over the place, and I think it's much more likely that 2s do better than 5s in either case, even on a strong CPI or on a weak CPI. So I would be long some 2s, 5s, long 2s, short 5s, because to me it's going to go down in either case. The interesting ones, 2s, 10s, last week did nothing, but I think that if you can be short at 420, why not? And 5s, 30s, if you can be short at 80, I think I would definitely do it. But the bond market is really going to really be affected by the CPI, especially at the short end. I just can't see a scenario in which the Fed can easily say that they're not going to cut or twice this year. Politically, I think that that is silly. So I think that they will maintain the 2 cuts. So if you get a move up in the 2s, I think it's definitely a decent buy here. I think that that is going to be, very well rewarded. 417 to 420, if you can get them there, I think by the time the Fed comes around, we will be below 4% again. Last week, the ECB cut as expected, and now Schatz is a completely dead contract. I think the odds of the ECB moving again in the next 3 months, unless the data turns very, very dovish, are almost zero. So the Schatz is just going to go sideways. The interesting ones are just at the long end. You have the Bund, which is just unable to remain below 252. And you have the French contract, which actually is trading technically perfectly off the 200-day moving average. I hate the Bund and I hate the French, especially relative to the US. I think the US at 450 with a 215 real as opposed to the German with a 50 basis point real is a bit of a gift. But at the moment you're getting the dollar cross currents with people reallocating away from the US, and therefore that is not being transmitted as quickly as I would like, but I'm sure that it will be transmitted. To me, the risk reward of owning 10-year paper in France or in Germany is just absolute rubbish. I think that that is much more likely to go up than down, and that the yield curve is much more likely to steepen than not. If you have a look at 2s, 10s, eventually, now that it's dead, people are picking up yield by extending, because if you stay in 2s, you're not going to make any money. So it might go up a little bit, but eventually it just breaks. Eventually it breaks, so it could be doing one of these at the moment, but eventually, say in a month's time or something like that, it's going down towards 127, and not because the Schatz is going to move very much. I think it's going to be the 10-year that's going to catch up towards the US rates, and you're going to get towards the end of the year a big move into the US, because I think the weakness is going to be in the US. My view is very simple. The ECB has done everything it's going to do, and the Fed will eventually catch up. It's just that the inflation rate was higher in the US, but it's going to moderate in the US with a lag. And I think the lag has reached its level, and that is why I think that CPI from now on in the US could actually surprise to the downside. Inflation is always a monetary phenomenon which is worldwide because we are in a globalized economy. If inflation is at target in Europe, it won't be too long before it's at target in the US, and therefore I think that those spreads start coming in, and I see no reason to own Europe over the US for the foreseeable future. What the big money allocators are doing in Europe is pretty obvious. They're just playing the yield pickup game. This is Italy against Germany, and as you can see, it's at 94 basis points. So they prefer to have 3.5% in Italian paper as opposed to 258% in German paper, and that will continue. Every time there's a spike in that, it will get bought. And where are the all-time lows in that spread? They are around here, around 82. That was like as bad as it got, and I think we test it, and I think we stop everyone out and go through it. These kinds of levels around 75, I think, are likely to happen simply because there is no point in owning anything else. If you're European and you have to invest in euros, what are you going to buy? Are you going to buy something with a real rate of 50 or something with a real rate of 100? Well, it's pretty clear. And if you look at Germany against France, you can see that it's just going sideways in a very narrow range. And I think that that is likely to continue. I think the French market is likely to be supported relative to the German market. And then if you have a look at how clearly the French market just cannot stay below the 200-day moving average, that tells me that the Bund has to give up some ground, higher yields, and therefore the only position to have in the German curve is a steeper one, because the Schatz is completely dead. It's not going to go anywhere at all for the foreseeable future. The ECB is now on hold, no reason to do anything with Schatz, which implies that the only possibility is a continued steepener there, and the only place to put on that steepener is going to be somewhere around 60 basis points if you can see it, but that's about it. That's all you're going to get in the German curve. Let's have a look at the differentials US-Germany, and this is twos. It went down at the beginning of the week, and then on Friday it closed basically unchanged on the week. I just can't see how it's going to go through these levels. And this is the longer term picture. Again, I think the inflation differentials are going to come in between the US and the EU. And at some stage, this is going to turn and it's going to go back down here. That's the only way I can see that the dollar is going to remain weak. And I will remind you that one of my central tenets here, macro tenets for this year, is that the way that the administration is going to obtain its goals is to have a weaker dollar. If it doesn't have a weaker dollar, it just cannot meet the growth targets that it has set itself. I can't see how US growth is going to be higher than the deficit increase without a weaker dollar that they can export into. And the only way to mask the weakness of the stock market, i.e. have a stronger nominal value for the stock market, is by having a weaker dollar. So a weaker denominator and higher prices. I just can't see how a differential of 235, 250 is sustainable. What is the differential in inflation? I just can't see that the differential in inflation is going to be that high. So at some stage here, this has to turn. This has to turn and go towards 150 basis points differential at the very least. And that is why I think that this inflation report is going to be so important. If it shows that the differential in inflation is, tiny between the EU and the US, it just means that at some stage this year, the steepening in the curve has to be realized in the US, i.e. the Fed needs to cut. And as I keep on telling you, when they start cutting because the CPI allows them to cut, but also because the employment situation is weak, they're not going to cut by 25s. They're going to have to cut by 50s. And you have now a situation in which the ECB is on hold for the foreseeable future. So I think all the danger here from some level is to the downside. And that is why I think the dollar will remain weak in the medium term. Now, in the next couple of weeks, it could easily go up if this goes up. But at some stage, this has to turn, and therefore the dollar has to remain weak for the rest of the year. Whether it will do it next week, I very much doubt it, but let's have a look at the dollar, because I think next week actually could start going up and correcting, and then only after that go down. The dollar is really finding it very, very hard to break through this 98.80 level. And what is the risk reward? Well, the risk reward is that in the first few days it actually starts breaking upwards, and I will tell you why. I really lightened up at 114.85, and I think the danger is that it tries to stop everyone out at around this 112.70 area in the first few days of next week. What I am seeing is that the yen is actually breaking out of this range, and it could easily trade 146 the first few days of next week, maybe even slightly higher to stop people out. And the fact is that you're having a bit of a breakout in the euro Japanese yen, which indicates that there is really no weakness in the stock market in the first few days. Say it goes up to 166, the yen is weaker, and that sort of propels stocks, and it's not a big deal. But what I'm saying is that I think the dollar is going to be stronger the first few days of next week, and then we see what the CPI numbers are. I think that if the CPI numbers are weak, you get a weaker dollar. As I said, I think from now on it's all about these differentials and whether the Fed can bring the differentials down or not. The first few days I can't see it, but after that I can. So if we look at euro effects, I think this kind of level is where you are likely to be before CPI, and then it all depends on CPI. If CPI is weak, I think you're going to start going back up towards 115. If it's strong, I think you could easily come all the way down to 111 or even 110. That is the kind of range that I'm looking for. I favor a weaker CPI, and I think that we will be not very far from where we closed this week, next week. But my my fear is that the first move is something like 112.60, and that's the kind of level that the risk reward says that you've got to buy it ahead of CPI. Well, GSG showed some sign of life last week, and the one I keep on looking is GLD over GSG, and how much better of a risk reward is to own GSG as opposed to GLD at the moment. Could easily be some sort of an ABC and come down to these levels, and that's a big move in percentage terms. I have absolutely no idea what's going on in gold. I just know that I don't really like it, and it's probably going to go sideways, stopping everyone out who is long, because I think people are very long. And I just know that GSG, after this long period of stability, and it's probably going to take many months, is more likely to break to the upside than to the downside. And I just can't see how a break to the downside happens unless we go into a recession, almost a depression. Because let's have a look from 2020. We are now at the same price we were in 2015. And how much inflation have we had since 2015 in commodity prices? A lot, right? So it's very unlikely to start breaking down unless you have a complete recession. To me, the risk reward is to own it and prefer it to gold, and certainly, look for dips back down towards 1250 in gold GSG. Bitcoin I've been leaving alone, and I'm really not interested unless we get in this area, which is between 92 and 95,000. I will let the market tell me what it's going to do, but to me it's significant that you have a stronger equity market and that BTC can't keep up. It's normally a risk-on asset, and when you have a little bit of risk-on and BTC doesn't respond, that just basically means that it is weak on a cross, and this is basically BTC over SPY, IBIT over SPY, same thing. It is where we've been since 2025, so it is really tracking stocks, and if at the moment it can't break up above this all-time high close that we had in this range, and it keeps on bouncing off it, to me that is a sign of relative weakness. And unless I think stocks are going to go a million miles to the upside, and I don't, I think the odds are that we come down towards these kind of levels where I will be a buyer. But for the time being, absolutely no reason to get long of it. What is going to be interesting to me is STRF, because we are having a dividend of 264. Ex-date is Friday the 13th, i.e. next Friday. I think if that dips early next week, I think it's going to be a very good buy because it's got a 10% yield. I certainly would prefer that to owning the even BTC next week. Any kind of dip here that fills this gap, which I missed buying because I wasn't looking, you really have to buy it, because at par and getting a 10% yield, I really don't see how this, I bought a ton down here, but I sold it all. I really don't see how STRF can really leave you in the lurch. What is going to happen in the next few weeks for STRF not to give you a really good dividend and keep on giving you a 10% yield? As time goes by, people are going to realize that STRF is in times of Bitcoin not doing anything, it's a much, much safer product than MSTR. it's much better to own STRF at the moment than MSTR, simply because MSTR, and we have a look at it against IBIT, and this is the one that I like to trade, it's really not doing anything, right? I mean, it's in this range. It could easily remain in this range for another month. And if it does that, there is absolutely no reason to own MSTR. It's much, much better to own STRF because you're getting a really good coupon. I think that in SPX the situation is pretty damn clear, and the weakness happens below 58.65. Unless we start breaking 58.65, there's absolutely no point in selling this market. Where's it going to go up to test? Well, 60.90 and then 61.18. Those are the levels, and I really wouldn't be surprised to see them at some stage next week. Does a weaker CPI help the market? I think it does. A strong CPI will also hold it in. I mean, it will trade with bonds on CPI, but I think that equities suffer much less than bonds on a strong CPI. I don't expect a strong CPI, I expect a weak CPI. But that is what I think is going to happen to equities, and unless I see a daily close below this level, I'm just not interested in trading to the downside at all, because I think this is a rotation market at the moment in equities rather than a trending market. And I will just leave it alone. I think still that we are in a window of weakness, and I think the window of weakness will manifest itself. But I'm not going to, sort of waste my nerves on trading to the short side until we break 58.65. I think once we break that level, that window is open, and we go at least down to 56.68, at least. But it's not going to happen, unless it starts happening. I'm not going to start participating. There's always a bull market somewhere, and as you know, I think that this is going to break to the upside. This is QQQ over SPY, and basically the AI story. When will we know that it's starting to break? I think this 88.70 level is very, very important. If you mark it down, if we start closing through there, we are testing 89, this level, this 89.70, and that will tell you that really NQ is likely to test the highs and even break them a little bit. Otherwise, if it starts coming down, I would love it. If it came down, I'm going to buy a hell of a lot more down here, because I think eventually over the course of the year this breaks upwards. And the other one is XAR or ETA, same thing. XAR is more interesting because it has much more of the drone technology AI in it, which confirms my QQQ over SPY. You can see that it's just, unless you own it and you shut your eyes and you buy it, it's gone, right? And where's it going to go to? Well, this is the kind of minimum level that I expect, okay, around the 34.50 area, and then I do expect it to go all the way up to 37. It's the only sector that has no headwinds to it. We saw what the Ukrainians did with $500 worth of drones to the Russians, destroyed untold billions of dollars worth of aeroplanes, and that is the kind of spending that the US military is going to have to do to maintain its lead. So these companies are, to me, golden for the next 5-10 years, and it makes perfect sense to me that you can't buy XAR on a dip, because there is no dip. Now, will there be dips? Absolutely, there will be dips. But I think the trend now in XAR is very much to go back to the highs. So whether you buy it now or you wait for a dip or you keep on buying it every 1-2% that it goes down, up to you. But that is to me the bull market. The technology and defense part of technology to me is the one that makes sense, because whatever they're going to do with the one great big beautiful bill, whatever you call it, it's not defense spending that's going to get cut. It's going to be a whole load of other things, but not defense spending. One last word about EEM. I told you last week to keep watching it, because if it's not weak, it's telling you that equities are not going to be weak. This 47.93 level, I think, is going to be absolutely key. I would not be long there. I would be absolutely flat if you're long. I would flatten out up there, because I think the risks are that it comes back to something like this level where you buy it again. But EM is just telling you that the equity market at the moment is not weak. It's much higher than it was at the beginning of the year. It's the one of the star performance in the equity space, and I think that continues, and it takes out this high and it gets everyone long, where you see 47.93, and then it can back up. That's the kind of behavior that I expect, and why I think it's probably pointless playing the US until it breaks that 58.65 level, because it's going to be supported by all the other markets. So what does risk reward favor for next week? Well, if CPI is weak, like I think it will be weak, 458 area in 10-year notes is a great place to get long of them. Otherwise, really 10-year US against 10-year Germany, because I think Germany is now stuck, especially at the front end. So if you're going to get some reward, you're going to get it from the US. The other important matter is you should read this link. Click on it and read it, because it's telling you what is actually going on in the labor market. The labor market in the US is not strong. And if that is the case, it can only be a matter of time before CPI catches up with it, and also the data in the unemployment data starts really reflecting some weakness, and then retail sales reflects it, and then GDP reflects it, but those are just backward looking. So it's going to be the employment data which first starts to alert you to the fact that things are not as good as they appear in the US. Thank you very much indeed, and tweet you tomorrow.